Let's go.
Okay. Today, I want to talk about inducement of liquidity. Now, inducement is sometimes it comes for both sellers and buyers, right? Now, inducement of liquidity, you probably could have a point of interest. Maybe you're looking to take an entry at this zone, right?
Yeah.
Looking to take an entry at this daily order block. Now, price has not gotten to the daily order block. It just tapped on the wick of these breakers, this mitigation zone. And what happened? It sold off. Now, price selling off, you see the amount is sold off for 3 days. Price selling off and running like about, if not up to 200 pips, okay, almost like 100 pips, 100 and something pips. Now, those people that were in that trade, they may likely not know that price has not actually gotten to its final destination. Price now selling from this point. Now, inducement, let me give a definition first. Inducement of liquidity is when price actually induce buyers or sellers just a minute, I'm coming.
Okay.
Okay, now inducement of liquidity, right, is when price sort of induce buyers or sellers by tricking them into going into a trade. And those people that will hop in that trade, price has not actually gotten to its final point of interest where he would like to make an action in regards to that trade people are looking to go in. Now, it's usually trick those people that have FOMO, fear of missing out on a trade. Now, price knows he wants to sell, or price knows he wants to buy, and he probably wants to use this daily order block zone. Now, price using this mitigation zone to sell off, leaving this rejection week. This high here is inducement. This is even equal highs. This higher price depth is inducement. Now, price will still come back to this zone, mitigating this order block, stopping out those people, those early sellers, and using those early sellers as what? Inducement for what?
Liquidity.
For the sell. He used them first as inducement for buyers, stopping them out. Then use buyers as inducement for sellers. He used sellers as inducement for buyers by taking them out in their stops, and use these buyers that are buying here, these buyers are buying here, as inducement for sellers. So inducement is when traders hop into a trade too early, prematurely, because of fear of missing out, not allowing price to get to the actual point of interest, because price will just give them a false move. Oh, price will just come to close to your point of view and just start dropping, maybe 30 pips. Now, if you jump in, oh, it's leaving me, fear of missing out. Instantly you jump in, price will reverse back again and go to your exact point of entry, inducing those early traders that jump in the market. I believe you've experienced it before.
Yeah.
That's inducement. Now, what is liquidity? Liquidity is where a major move started from. Now, liquidity. Now, you see how this move started from here, this zone. Started from here, where a major move started off from, with large orders sitting in that zone. Market maker could target this high right here. I don't know if you're getting it. Market makers could target this high right here and use this high as what? Liquidity. Because that's equal body candle. It's too clean. These 3 days is too clean to live like that. Now, market makers would like to sell from this point of interest if they actually want to trap sellers. If they actually want to deal with sellers that place their stop above this daily order block and use them for liquidity, thereby pairing their buy orders to their what? Buy stops, and using their buy orders to place their massive sell orders, they will just use what we call a turtle soup buy model and push price and sweep out this what liquidity resting above this clean body candle. When they do that, that's when you see that long rejection wick.
Yeah.
You just reject and pull down. That rejection you see is manipulation. That's what when you are used for liquidity. So inducement and liquidity is a two different thing. Now, liquidity can happen in a valid breaker block or a valid order block or a valid proportion block or an equal highs or hold lows. Those are liquidities resting there. This clean high you see right here. Now you want to sell on this daily order block, which is very clean. It's necessary to sell from here, right?
Yeah.
And other block, the fair value gap, high probability trade setup, premium array. Now remember our premium array, what did we talk about? Old highs. Meaning it's necessary, it's normal. When you don't know these things, you just feel it's not normal. It's normal for market makers to come and sweep this high. It's normal. They know that you are putting your stop right here. So that's place you're putting your stop. You see this clean high is liquidity. This other block is valid. But if they want to actually deal with sellers and they don't want you to participate in this sell move, they want to pair there, because when they are pushing that buy to that zone, remember, it's a buy to sell.
Right.
So that buy becomes the buy they will pair with your buy stops, taking out those that are interested in selling. You will not be participating in this sell move. So whatever you're doing in terms of looking for your point of entry, put liquidity at the back of your mind that you'll be induced anytime. And always think extreme like the market makers. All they want to do is induce you, not allowing you participate in that move. Sometimes you want to buy, I believe you'll be taken out and price will just go to your direction, even 100 and something pips. Now, that is a turtle soup buy or a turtle soup sell model. That's stop losses that were used, that were pushed out as liquidity, will help fuel price momentum, and you see price just going your direction so fast, not allowing you to join in. All your stop losses have been used to pair their orders. So when you're doing your trade ideas or you're marking your point of interest, you have to think extreme like them. I don't know if I'm making things clear with you.
I'm with you all the way.
That's the more reason why you cannot be selling or buying without thinking that your stop loss might be hit. It's a game of probability and it's a game of a chase of liquidity. So sometimes if you might want to buy, instead of you now losing too much, you might put your entry at the 50%. At the 50% of the OB mean threshold. So even if they want to sweep that high, use a small lot size, you would not be shaken. You put your stops. So usually I put my stops above like this. Because if they might want to sweep, usually they like a turtle soup buy or sell model is 20 pips above or below the other block. A turtle soup buy or sell model is 20 pips above or below the other blocks. 20 pips. USD card did that to me. It swept below my entry 20 pips, 25 pips, and bought like it has never bought before. Started flying up without even giving any re-entry, no break, nothing. It swept everybody's stop losses and used a rejection wick and move. One of my students even cut the buy, sent me a DM and said, I cut the buy using your setup. Most of them that are very smart, when they watch out for my setup, they just use it and refine that because they already know what to do. One thing about my students is that I like the fact that when I teach these students, they all develop their own kind of trading. They don't even follow my pattern. They all develop their own kind of niche that works for them. And I really love that. There's nothing they will be doing that I would not understand what you're thinking. Because in this class I'm teaching you, you are supposed to develop your own trading. I will teach you other blocks, liquidity. So you can decide to be a liquidity trader, maybe trading from equal highs or equal lows, where price will push sellers. You put your entry. If it's intraday, maybe 5 pips above or just at the entry, intraday of 15 pips, and you just buy or sell from that zone. You can be a discount or premium trader, meaning when price has done his move, you just use your Fibonacci and measure from discount to premium and enter at an OT, take your 30 pips and you are done. I teach all that. I taught you discount and premium your first week, right?
Yeah.
How to measure from a range high to a range low. If price is traded from discount to premium, and if it's traded from discount to premium, you look at where it has formed as a what discount low and it has discount high. When it's making a retracement, you enter at a OT and continue to premium. So you can just be a Fibonacci retracement trader by looking for liquidity where price will come and retrace into, fill up an imbalance, maybe fill up a fair value gap that is left at discount, enter from that zone and continue to go to premium. All these I've taught you. So you can develop your own skills based on what works for you. This is also inducement. You see these days that we're buying and selling here, all this for what happened? Price induced all these people right here. He wants to sell, right? What did he do? He pushed the buy up above what? This high. Push the buy order what? Up above this high. Now, if I measure from where price pushed up from this zone, because this is the opening of the candle, right? It traded into the count of the previous day and pushed price up. After pushing price up, now every one of these persons are looking to sell. Every one of these persons are looking to sell. Now, from the previous day high, because it opened at what? Discount. It opened at discount and it moved price to premium. Pushing it up is about 70, 30 something pip, right? Which is just a standard turtle soup. Now, what happened again? He wants to sell. And what did he do? He pushed price down. Because this is the opening of the candle. It opened exactly at the previous day high, creating equal highs. Open at exactly, which is what? Premium. Previous day high, I said it's premium, previous day low is discount intraday. I taught you that during market structure. Power of 3. If he wants to sell, he opens at premium. He might push price up, which is the manipulation, maybe 10 pip above previous day or 20 pip. Accumulation on the what? On the previous day high, which is premium array. If it opens that zone, and manipulation, it will push it up to 15 pip above previous day high and sell down. Now, from previous day high, it did not manipulate. It's not all the time power. It will show power. Just have all these ideas in case he wants to, you know what to do. It doesn't mean it's a scripted something that will play out like that all the time. No, they switch their patterns. But when you have knowledge of all of this, anytime they switch, you can know how to follow them. I don't know if I'm communicating. So it's not all the time you wait for price at premium to push into extreme premium before you sell. Sometimes it might just even sell from that zone. Most especially if he knows people wants to enter their sell order, maybe 10 people above. They are waiting. Just what? Crash price and just take them out and stop.
Leave them.
They don't participate. Now looking for price moving from that previous day high down. You can see, what did he do? He stopped out all these people, traded into discount by taking previous day low. And that's 60 something pips. He traded into discount, took out this low, and couldn't break this low. What happened again? He pushed price up again, taking out those people that were selling in their stops. And what happened again? He crashed price down. So you see how they work? We need to think like them. Now we have our price moving into a premium array because that zone will probably have a breaker or something around that zone. We did. But to me, this is, this is inducement, right? Price just reacts to the weak. This is inducement.
Yeah, it still needs to go up a little bit more.
It has not really reacted to anything. So this right here is inducement. So there's every possibility if price is visiting this other block, it might use the fair value gap to just what? Sell for some minutes. The next thing, price will be aiming at this zone. This is where price will be aiming at. Because he knows people will be looking to trade this other block. Yeah. Can you imagine above the other block?
So
It will use this fair value gap and sell for some minutes, maybe for that day. The next day to push price up to this zone and sell from that zone. Because if you look at it, that was actually the zone that started the sell on this second phase, on this phase. That's a sponsored move on this phase. Now remember, you have liquidity above. All these are what? Liquidity. So if price don't want to take you out, it will just respect that other block. But always think the worst of price. Always think the worst of price, so you can be on his good side. Price might just decide to sell off from this zone, or price might decide to do a stop hunt, because we also have a fair value gap right here. This is a what? An imbalance.
Nothing is for sure.
Exactly. But when you have all these probabilities in mind, you know that price will respect it. But the reason why I will bank on this zone, I would expect price to react from this zone. The reason why I would expect price to react from this zone, that is a key zone that actually what started this break of structure. That started, this zone has been taken out already. We saw our price broke above this zone. Broke a low, it broke a high. Now, there's something about what we call a safe entry. It's called a bullish breaker. It happens on lower time frame. It happens on higher time frame. What did I say? A bullish breaker. A bullish breaker will break a low, break a high, and return to test the block that caused the break of structure to the upside. A bearish breaker will break a high, break a low. Now let me do it for you with an arrow. This is a bullish breaker, right? This is what we call a reversal, a bullish reversal pattern. It's a bullish breaker. It's a sort of a confirmation entry. What we call what?
Confirmation entry.
A bullish reversal pattern. It's sort of a confirmation entry. When you are looking for this pattern, it plays out every single day. You hardly lose money. If you look for this pattern, right? It plays out on intraday, it plays out on what? Swing trades. If you look for just this pattern, it's called a breaker. It's a breaker. A bullish what?
Breaker.
Let me write it out. It's called a bullish breaker. It's a bullish reversal pattern. A high, a higher high, a lower high, and a higher high. Now, price creating this lower high is to stop hunts. What? These early buyers. Use them as inducement. He used this early buyers as what? Inducement. He used them as what? Inducement of liquidity. He pushed out their stop loss. After taking them out in stop, he moved aggressively and take the sellers out in their stop. This is the sellers. This is where they place their stops. Now let me put it there. Stop loss of sellers. Is every picture getting clear with you now, day by day?
Yep. And I really like the videos from yesterday too.
Sorry?
I really like the videos from yesterday. Those 3
One I
videos.
gave you.
Yeah, I watched 2 of it.
It's aligning with what I've been teaching you, right?
Yeah.
Or did you see anything on those courses different from what you have been learning?
No, it's what I've been learning exactly.
Now, this is what we call a bullish breaker. I will do a bearish breaker for you. Now, a bullish breaker, this is buyers. This is where they place their stop loss. It comes and take them out aggressively. It helps price to fuel momentum, and it took out sellers. Are you seeing now? It took out sellers in their stops. In their stops, because some of these sellers would have placed their stop loss and break even right here, or place their stop loss at this zone. It came back and took out sellers and what retraced into this zone, and that zone will have what we call fair value gap around here. So look out for the fair value gap. That's an imbalance. This zone will barely have a fair value because as price is moving up aggressively with this momentum, it leaves an imbalance. So from this low to this high, it becomes your what? Your dealing range. Dealing range low, dealing range high, fair value gap, retrace into optimum trade entry. Anytime you take a trade from this zone, if you, no matter this, even if you use 5 standard lots, 30 pip, you're out of the market. There's no way you can lose money. You build your confidence. You begin to understand that price will only give you an entry if you are what? Patient, disciplined, and follow the what? The rule. Am I communicating?
Yeah.
So that is what? A bearish breaker. It's part of inducement of liquidity. That's why I'm teaching you this course today. It's part of inducement of liquidity. This is what a bullish breaker. Now I'm going to do a bearish breaker for you. Now looking at this structure, do you see what is playing out here? It creates a, it's a downtrend. It's a downtrend. Creates a high, right?
Yeah.
Isn't this high created?
Yeah.
It creates a low, taking out them in their stops. Are you seeing it? It pushed price a higher high, this higher high here. It's coming back down into this zone. And around this area on the lower time frame, there's a fair value gap. And what will happen now again?
To push price up.
Taking out this high. That's why I'm looking to buy around this zone, GBP USD. And where's my take profit? This high.
That high, right?
Look at my setup. What's broker? I think 100. Look at it. Are you seeing my take profit?
Yeah.
What did I put? That's high. That's high. You see, even when I've not even I didn't even open here. You see that place I was teaching you now that I could use as liquidity. That's what I'm looking at as my take profit. I could also take profit in this imbalance because it's better you take profit in an imbalance. Price would definitely take you out. You see this fair value gap. It's better you just take profit right there.
Right there, yeah.
So even if price might not necessarily sweep this high, you are already safely out of the market. This area, the eye you want to see taking out first is this zone. This zone. You want to see them taking out first. So any swing trader can take profits here and close in partials and move stop towards break even. After moving stop to break even, you might be giving another entry to reward, join the movement. Take this high as your first take. My first take profit is this high. That's my first take profit. Second take profit is high. Final TP is high, but I could just take profit at this fair value gap. I know that it will be filled. It's an imbalance. It will be filled. It's an internal range liquidity. It will be filled. According to one of my students, she says she has my voice singing in her head, explaining the courses. Oh my God, you Americans. She's an American. You Americans are so funny.
Yeah, I'm not an American now.
All right, sir.
Now,
okay, sir. Now, I said a bullish breaker breaks a low and breaks a high, right? Now, a bearish breaker does the opposite. It does what? The opposite. It does the opposite. It's buying, right? It's buying, comes down and break this low, right? Move up and break this high, right?
Yeah.
Right? Comes back down there again and break this low aggressively, then go back up here and give a re-entry.
Okay.
Now let me arrange it properly. This is what we call a safe entry, a bearish breaker. It's selling, it's buying, right? You're thinking, oh, price will continue buying. All of a sudden, it creates a new low, taking out those people that were buying in their stop, and aggressively move up, taking out people that were buying in their stops. It took out people that were buying in their stops and aggressively moved up, taking out sellers that were what selling in their stops, and we gave a reward into this zone. So this right here is a bearish reversal pattern. Let me fix it. Sellers, buyers, there's a buyers stop loss, sellers stop loss. Come in, I think I made a mistake with this. Let me draw it again. Yeah, this is it. You can see it's just like the opposite of a bullish breaker. This is a bearish reversal pattern, is a bearish breaker. And this zone, it has a mitigation. A breaker carries a mitigation, while a mitigation is a failed swing. Now for a mitigation, is just going to be this and this, from this high to this low to this zone, failed swing. Now let me arrange it just the way I did. This is where buyers place their stop loss, right?
Yeah.
It was run over. It was run over by this sell trade, and this is where sellers place their stop loss. Because buyer stop loss was hit first, unlike bullish breaker, seller stop loss was hit first. No, but bullish breaker, seller stop loss was hit first. Was hit first before they went forward. Before they went for, because this is buyers, they are buying, they hit their stops.
Wow.
It broke a low. It took out buyers first, rather, and went for sellers. Why this bearish breaker took out what buyers first and went for what sellers? Why a bullish breaker took out people that were looking to buy, it took them out first, and what took out those that are looking to sell. So it took out buyers.
So that area where you put your buyers, the seller stop loss.
Wait. No, seller stop loss. Yeah. So it took out buyers stop loss first, and it came for sellers stop loss. Because those that are buying that they usually put their stop loss below.
Mm-hmm.
And those that are selling, they put their stop loss above. Now this bullish breaker was driving down. It was selling, right? And it broke this short-term high, right? And people will be expecting it to just mitigate around this zone because it's a break of structure and continue buying. But no, it came back and broke that low. That's taking out those people that you gave entry to buy in their stop loss, right? And now made a massive momentum up, and it didn't come back again, just feel the fair value gap around this zone and move. Now, a bearish breaker. Now, a bearish breaker. Now, a bearish breaker was driving up. Price is an uptrend, right? That's it's already in premium. Now it gives people an entry, started selling. It broke a short-term swing low. It broke a short-term swing low. Start breaking a swing low. Now these people that were selling, they place their stop losses here. Why these people that were buying, they place their stop losses what here? These people that are buying, they place their stop losses what here? So you also have buyer stop loss right here. Why you have seller stop loss? That's the inverse. What is knocking out buyers on sellers on this zone is knocking out buyers on this zone. See that, right? It's knocking out sellers on this zone. It took out sellers stop losses very swiftly, broke above a short-term high, and came back down and broke above this short-term low, because this low that created this high, people will be thinking, oh, it will just mitigate this other block and continue bullishness. No, it broke below, creating a lower low, a higher low, a lower low, a low, a lower low, and a higher low, a low,
a lower low, and a higher low. Now, this higher low is now what is called mitigation. It failed to what? Break this swing low. So failing to break that swing low is what we call what? A mitigation. So for mitigation, it's just from this zone up, mitigate, move. Now, it took out what? Buyers activating their stop loss. Yeah, it took out what? Sellers first. Now, yeah, it took out buyers activating their stop loss. Move up again, taking out sellers in their stop losses. Move down again, taking out buyers. They always do that intraday. GBP/USD is a graph for that one. Taking out what? Buyers. The main intention, the main move, as long as it broke above a previous swing high, and now it broke above the short-term low, failing to break, as long as it broke above this zone, it broke above a short-term low, giving us what? A break in market structure. It opens what? Intraday at discount, it moves to premium. It breaks down, breaking structure, showing you it wants to sell, right? Now we'll be waiting to enter at a return to order block. Intraday does this. It pushes price to extreme premium. Now it's taking out everybody that were already selling on Asian session before London. Judas swing. Judas what? Swing. It now takes out everybody that already placed their stop loss because price has already moved this volume. Place their stop loss what at this entry. That's why if you're selling on Asian session, just exit in profit. There's every possibility that European session will do a what? Judas swing move. It moved aggressively, pushing price to extreme premium. You not think price is going to buy this a break of what? Market structure to the upside. You want to enter from this zone. What will happen? Crash price below, taking out all of you that we're buying. Are you seeing the movement? Yeah. And move price up aggressively again. You are taking out this. What's wrong with price? You move up, move down, move up, move down. Jesus, I'm confused. It's the what is the model? It's a buy. It's a bearish model, a bullish reversal model. Now, when they will not push price up again, they will fail to break this swing high. Those people that were wise that stayed away can use this fair value gap as a safe entry and safely drive price to the destination. Is it getting clearer?
Yep. All clear.
It's happening every single what? Day. This will play out today. Watch out.
I used to chase price like this. You chase it up and down.
Like a robot.
Up and down the move.
Running up and down like a robot. Running and not resting. And you cannot chase price. It's price that will chase you out of the market. Price is prepared. It's always having koboko to chase out everybody that is chasing him. To chase all of you out in your stop loss. You will not participate in any of the moves. The best thing, allow price do its thing, because we've been a victim to that. That's why I always teach my students my experience so that you can learn from it and know, you don't fall prey. When you see price having this whipsaw movement, just calm down. It has already broken a low during Asian session, right? Give you a view that it wants to sell. Now, when London protraction wants to play, Judas swing, they'll push price above what? Asian high, taking out Asian high. Taking out what? Asian high. Now, the liquidity resting above Asian high is cleared. That's what a turtle soup sell model. It's cleared above with 20 what? Pips. And most of us usually use 20 pips for our stop loss, isn't it?
Yeah.
Yes. Now, they've taken you out a stop, pairing your sell with their buy stop. This is their buy. They'll pair this buy with what? Your buy stops. Pair their buy order with your buy stop, because your stop losses is resting above buy stops. It's a liquidity. Now, it is valid for a sell. Remember when I said that liquidity is different from inducement? What are the inducements? These sellers, this early sell you are seeing here, this high, right? It's the inducement. This early sell, you see these people selling. So this high is inducement. Now they push price up into a valid point of interest, taking out all these early sellers, they treat into what? Getting out of this trade. They will not participate. They are not participating here. They pair this buy order to their buy stop. And what? Those people that were buying, they were also inducement for what? Sellers.
Yeah.
These are inducement for what? Buyers. It broke structure already to the downside. This is a broke of structure or a change of character, depending on the time frame. Now they induce these people and broke structure to the upside, thinking, oh, it's a break of structure. Now we'll enter a return to order block around it, and use these stop losses they've taken that fuel momentum, and you see price will push below what? The people that are buying. Now, these buyers are inducement for sellers, and you push price up again into this gap that was created while price was dropping, and you see the trade begins to move nicely. This will happen today. Either this happens or this happens. This is what? A bullish. Why this is what?
Bearish.
Bearish. Take a picture of it. Okay, they're having a video already. You might want to take a picture of it.
Yeah.
If you trade this breaker pattern, it might not necessarily play out all the time, but in a week you see it like 3 times or even 4 times playing out in some pairs. If you trade just this pattern alone, right? If you trade just this pattern alone, right, you will be extremely successful and you build your confidence. This is what we call a confirmation entry, a reversal, a bullish reversal, and a bearish reversal. A bullish reversal and a bearish reversal, a high, a higher high, and a lower high. Now, failing to break this high is what we call what? A failed swing or a shift in market structure.
SMS.
So a mitigation is what? A failed
Swing.
swing. Remember I said so the other day when I was teaching you. I said that when I was teaching you mitigation.
Yeah.
You remember?
I do.
When I was making mitigation explanation.
Yeah.
Okay, when I was explaining mitigation and breaker, I said there are 2 different things. That a breaker carries a mitigation. This is a failed swing. A failed swing. So if this is a breaker, it carries a mitigation. This is a mitigation. This is a breaker, it carries a mitigation. So that's all for our class today. We're almost wrapping up, just 5 minutes more. You have any question? I believe today was very insightful. This will help you for intraday trades and even swing trades. If you see this pattern, if you see this pattern plays out, if you see this pattern plays out, if you see this pattern plays out, either a bearish or a bullish breaker with a fair value gap imbalance, giving you an imbalance, my dear, trust the process and take it. Your stops above this high, entry fair value gap, because an OB will be carrying this fair value gap. So your stops above the OB, or if it's a breaker that carries a fair value gap and you enter safely, sometimes you can get a breaker around this zone. You see a mitigation block around this zone. See them around this zone, mitigation blocks around this zone. So when you can take your entry at the mitigation blocks or at the fair value gap carried in. The fair value gap it's being carried by an OB. It's got a sponsored candle carrying that OB. It's your point of interest what? 2. It becomes your what? Primary point of interest. Why your mitigation, the breaker blocks that is around this zone, the breaker blocks inside this mitigation becomes your secondary point of what?
Interest.
Good. So price can react either from your primary point of interest or your secondary point of interest. So when you see these 2, trust the process and go for it. Your stops cannot be more than 10 pips, but you have over 50 pips take profit. Twice in a week, that's okay. Yesterday, I waited for GU. I did the 100 pips to the pip. It took me out 100 pips. So even if I trade just that 1 pair this week, I am okay. Just imagine using a 5 standard lot trading 100 pips. Is that not $5,000? Because I am sure of that trade. 100 pips for a very reasonable trader should be okay for even in a month. Because we're so doing, you fall less into market trap. All right, so that's all for today. You can stop the recording, ask your questions.